Well, good afternoon, ladies and gentlemen. It's a great pleasure to be back here in the Eternal City, which played such a part in my youth. When I was a kid, the first history I ever learned, even before the Scottish Wars of Independence against the English, was Roman history. Secondary school, I was taught Latin. I don't remember very much about it, apart from Caesar coming to Gaul and saying, Veni, Vidi, Vinci. I came, I saw, I conquered. My wife was here last week, and it was more Veni, Vidi, Visa. I came, I saw, I spent a lot of money. It's going to be quite difficult to tell you about building a global financial profession in the 4 hours at my disposal. But I did ask Rachel how long I could speak for, and she said I could speak for as long as I liked, but you'd all go at 12:45. So I feel a bit like the farmer whose wife's filling in the list for the vet. And she asked him, what's the name of the pill we give the bull to keep him up to scratch? And he thinks a minute and says, I can't remember the name, but I can tell you it tastes of peppermint. Well, I'm just going to give you a flavor of what this is all about. Valuation lies right at the core of economic activity. It's involved in financial stability. It's involved, as I know only too well, in financial reporting. And yet, in the crisis, poor valuation practices were identified by the Financial Stability Forum and the G20 as a significant contributor to the financial crisis, with particular focus on financial instruments. Much inconsistency in their valuation. Lehman's, before they went down, were investigated by JP Morgan, who demanded more collateral. They didn't trust the Lehman's values. The White Knight, Bank of America, walked away a week before Lehman's collapsed on the grounds that their values were 66 billion different from those of Lehman's. Some of Lehman's trading desks were even valuing exactly the same instruments quite differently. There was just a mess. Fair value is not always liked by regulators, but cost is absolutely meaningless for financial instruments like derivatives and commodities. The audit regulators are concerned about fair value. The PCAOB and IFIA, their most common complaint concerns fair value, often on the documentation. And yet, reliable and consistent valuation is of fundamental importance to the prudential regulators and to market participants in determining the capital adequacy of financial institutions. If the values are wrong, capital adequacy is wrong. It's also an integral part of the risk management process applied by financial institutions and other businesses. So, to summarize, valuation is vital for investment decisions, performance reporting, solvency ratios, supporting lending decisions, pricing investment scheme units, risk management. Valuation matters. There are various challenges facing the valuation profession. Now, to some of you, this will be fairly remote, but coming from Scotland, I'm used to things being remote. When I was at KPMG as a partner, I took two of my London partners up to the Hebrides, these are islands off the west coast of Scotland, to do an investigation. And being London partners, they had to keep up to date and went into newsagent to get a copy of the Financial Times. I was a bit taken aback when the old lady behind the counter says, will you be wanting today's or yesterday's? But coming from London, of course, they had to have today's. Oh, well, she said, you'll have to come back tomorrow. Well, valuation really started out of real estate. That was the common one with people looking at. But gradually other issues came in, and Mauro and Doug have talked about several of them. It's often regarded as a technique. Many of us as accountants were trained in the early days, in my case 40 years ago, how you'd start valuing a company. But we're still not great at valuing companies. If you looked at Economica of 2012, there were estimates of the value of Coca-Cola. One was 17 billion, the other was 46. Apple, 25 billion, the other was 97. Google, 31 billion, the other 71 billion. There's something not quite right about these. Probably some assumptions are different, the purpose different, and so on. And as a KPMG partner, I was involved in one of the first brands ever to go on balance sheet. The client, Grand Metropolitan, now Diageo, bought Smirnoff. And in those days, the brand would have been counted as goodwill. In the UK, they had a ridiculous accounting system of writing goodwill off against reserves, and that would have blown a great hole through net worth. So we had a huge argument about whether it was really an asset. And we had a check. They'd signed a check for it, and other companies were trying to buy it off them at a higher value. So we weren't unhappy that this value, at least at cost, would be worth putting in. And the other aspect we did, when we put it on, we thought, how are we going to get rid of this thing? We can't just write it off over 20 years or something. And so we started to look at how did they calculate the price they paid, and it was a DCF calculation. So we used the DCF calculation to do an impairment test. And that was the test we agreed with Grand Metropolitan, that we would put the actuals into their forecasts, and if they fell below, the present value fell below the balance sheet value, we'd write it down. And that was the beginning of the impairment test, and when I became chairman of the Accounting Standards Board in the UK, I introduced that for goodwill and brands. And then we spread it internationally. And I remember the chief accountant at the SEC was apoplectic. He told me that in the United States they'd discovered the accounting for goodwill and brands some 30 years earlier, and that was to write them off over 40 years. And as I explained to the gentleman in the United Kingdom, we have brands such as Johnny Walker and Gordon's Gin. They're actually older than the United States. And in my humble opinion, I've done more for the sum of human happiness than the United States. And personally, I'd write off America before I'd ever write off Johnny Walker Black Label. But you can see how sophisticated they've come. I was very impressed with Doug's erudition. Certainly different from the partners I had 20-odd years ago. In those days, if you had half a mind to join KPMG, you were probably over-equipped. And we introduced intelligence tests for partners. This had some rather surprising results because we found there were regional variations in the answers. When we asked the Glasgow partners, what's the odd one out between a cabbage, potato, and a knife, the answer was a cabbage, on the grounds you can make chips with the other two. But what we didn't do in accounting was to allow homegrown intangibles to go on balance sheet. Rachel will be aware that when Australia switched to IFRS, Mr. Murdoch had to take all his mastheads out of his Aussie accounts. We didn't trust the numbers. And Grand Metropolitan, they said, well, we've got Bailey's Irish and all these other drinks. Fine, you didn't buy them. We're not going to allow you to put them on. And the reasons accounting standards setters don't, they recognize their assets, we don't trust the numbers. And that's an area we've still got to deal with. So the question is, who are the skilled valuers? Who are the cowboys? You know, my institute, the Scottish Institute, the oldest, 160 years old, we have a tradition. But for the valuers, it's new. And you have the question, is there a profession? And when you listen to the chief accountant, who was the deputy chief accountant at the time, Paul Beswick, 3 years ago, looking at the American profession, and he queried, he says, you know, in this country, America, we've got 4 business valuation organizations. There are 5 different credentials, each with different exams for them. How to know which one's the good ones? And this alphabet soup of credentials, it's just confusing us. And is there a question of the objectivity of the valuer? Who are the good ones here that we can really trust? When I first became an accountant, I was apprenticed to Professor David Flint in Glasgow. And David taught me what an accountant was all about. We didn't have any accounting standards in the UK. We didn't have an ethical code. We didn't need them. We just watched David Flint in action. And he terrified clients. He was absolute ramrod. And that's what accountants have to be. And that's what a profession's about. We had the Scottish Institute. We were exclusive. You had to get through the exams. It upheld the standards. If you didn't meet them, you were out in great disgrace. But latterly, accounting standards have been based on a conceptual underpinning. And those of you who are new to the profession probably don't realize how much accounting's changed in the last 20 years. Accountants aren't great consumers of conceptual products. I mean, conceptual framework wasn't a phrase I used in the hallowed portals of the English Institute, or rather the Institute of Chartered Accountants in England and Wales. I keep forgetting the Welsh, but so do they. One of their council members was heading for Wales on the motorway when he was stopped for speeding, and he apologized. He said he was very sorry, he was going to Wales, hated the Welsh. Everyone he met in Wales, he said, was either a prostitute or a rugby football player. Oh, that's interesting, said the policeman, taking his notebook back out again. My wife's Welsh. Really? Said, what position does she play? Well, the conceptual framework made huge changes to accounting. The balance sheet used to be an optional extra. There was so much missing, it was hardly worthwhile showing what was left. On the right side, nothing was left. On the left side, nothing was right. And you see the changes that have happened recently. And next year, there'll be an even bigger one. Leases will come onto the balance sheet. And at long last, I'll fulfill one of my ambitions. I'll fly in an aircraft that's actually on an airline's balance sheet. A lease is a liability. You can't get out of it. We can measure it. It's taken us 18 years, but they've got to go on balance sheet. And the ISB estimates balance sheets of major companies in total will change by $3.4 trillion in liabilities, and of course assets on the other side. Pensions. We've got away from the gleam in the eye. I will be prudent, I will provide. No, you won't, you'll manipulate profits. Looks prudent on the balance sheet and you'll feed it back in bad times. You're not allowed to do that. There must be an obligation. And that's how accounting has changed. Pensions. When we looked at the international standards in pensions, if you had a scheme that was 40 million assets and 40 million liabilities and the assets fell in value by 10 million, you'd have a deficit of 10 million, but we didn't account for it that way. You'd say, well, what's the highest, assets or liabilities? And let's take 10% of that and say that's the market noise or the market bouncing about. Well, liabilities at 40 million, that's 4 million. Knock it off the 10. That brings you down to 6. Now spread that over the working lives of the employees, say 10 years, and the accounts would show a deficit of 600,000. Now explain that one to your granny. You may as well take the 10 million, divide it by the cube root of the number of miles to the moon and multiply it by your shoe size. And that's what we've had to drive out of accounting. But that's what a conceptual framework does for you. And that's in valuation exactly the same sort of things that we've got to get there. Valuation's at the tough end of accounting. It's at the judgment end. It's easy to divide cost by 10 and amortize over 10 years. It's different if you have to judge a value. And that's led us, when we're in judgment, we're into professional standards. And that's one of our major objectives in the IVSC, a set of standards that Mauro and Doug are helping to create. And what is in there? Entry requirements. You need to have these entry requirements to look at them. Core training. What's the competencies? What's the work experience you need? What's the CPD? What's the code of ethics? What's the monitoring and oversight? And what I would like to see eventually is, can we get a universal designation? In accounting, we have CA, CPA, ACCA. They're known worldwide. I mentioned already there's 5 different ones in the United States for business valuers. So can we agree that if a professional organization meets the criteria set by our professional board, that they then would be able to issue some international identifier that everybody then recognizes? We have 3 objectives. The first I've mentioned, get professional standards, to create a profession. The second is to have a single set of high-quality global valuation standards. Here I go again. This is exactly what we had to do with the ISB. And accounting standards evolved nationally because that's where you got your money. You didn't go outside, but now you do. You go outside and look for funds outside. And globalization is inconsistent with having different pockets of ways of valuing or different pockets of ways of evaluating. And that's one of the main issues that we're looking at. So we're going to try and converge standards. We've already made a memorandum of understanding with the major professional institutes of valuation. We've agreed that we have to come down to one single set, and that's what we're working on. So it doesn't matter if evaluation's done here in Rome or in Rio or Reno or Pindi, we'll do it the same way. And that makes as much sense for value as it did in accounting. We've got relationships with the ISB. Doug mentioned the problems of IFRS 13. We weren't trying to say how you value. The idea is IASB says when, the type of value that's required, the international valuation standards will then say, and here's how you get there. And that's the key trick. Well, our initiatives, the third one is really part of the second, a single set of high-quality global standards. I mentioned at the beginning that valuation is critical both for financial reporting and for financial stability. Let me take your mind back to the global financial crisis. As you get older, you tend to forget things. I was in a pub in Edinburgh not so long ago, listening to this old couple opposite me chatting, and the old boy mentioned that he had a lovely lunch in a different pub, and asked them the name of it, and he said, oh goodness, give me the name of a flower. Rose. Nope. Daffodil. Nope. Lily. That's it, he said. Turned to his wife and said, Lily, can you tell me the name of that pub that we had? Well, you'll also remember in that time we had IAS 39. And I've often said if you understand IAS 39, you haven't read it properly. We inherited it. It's hugely complicated. In the crisis, I was a member, as chairman of the ISB, of the Financial Stability Forum, now the Financial Stability Board. 5 weeks after Lehman emergency meeting, I have never smelt such fear in a room. It was quite clear a lot of people in that room thought the whole capitalist system was going down. And one of the major problems was the frozen markets, the illiquid market. And the prudential regulators turned to me and says, and what's the ISB going to do about it? And I said, we don't value. We take the values we're given, but that's not our job. There's a profession out there that does it, and that's when we discovered there wasn't. And we had to sit down with FASB and the SEC, and we had to cobble something together in about 4 or 5 weeks. This is what you do in illiquid markets. You don't take fire sales, and this is how you handle it. But accounting came right up to the height of political problems. You heard last night the speaker saying that accounting was blamed in part for the crisis. Well, you may not know, but during the crisis, we heard that President Barroso of the European Commission, Chancellor Merkel, President Sarkozy, Prime Minister Berlusconi got together and discussed IAS 39. Well, I'd love to have been there. And I was interviewed by the BBC shortly afterwards, and the interviewer said, in this crisis, fingers are pointing, and the fingers are pointing at you. You are the man that's caused the crisis. And I said, they're right, it's me. I made banks give up their risk management systems. I made them give mortgages to people who had no assets and no income. I made them take these mortgages, break them into tiny bits, add them to thousands of tiny bits from others and scatter them worldwide. I made the credit rating agencies give them AAA ratings. I made people buy them without due diligence and having a clue what was inside them. It's all my fault. And there was a silence, and the interviewer said, for the benefit of overseas listeners, that was irony. If you want to know, and our speaker last night didn't say, what happened to the crisis? Look at the banks. The percentage of their funding that was equity-based in 1900 was 20%. 2000, it was 5%. Just before the crisis, on average, it was 2%. You don't have to lose much to lose 2%, and they lost it. And if you look at how big they were, the 3 largest UK banks, in 1950, 27% of UK GDP, 2000, 75% of UK GDP, 2007, 200% of UK GDP, and very little equity. And that's, if you want a quick answer to the crisis, that's what it was. At one time, 1/4 of the world's GDP was propping up banks, mainly in Europe and North America. Not in Australia, not in Canada, and not in most other parts of the world. But that's where they were. And there's a problem. Sometimes you have to face facts. The London Evening Standard reported that this guy went into a pub, asked for a pint glass, said put 3 malt whiskies in there, 2 crème de menthe, a limoncello, and top it all up with Bollinger champagne. And he took it, knocked it down in a oneer, went white, staggered about and said, I really shouldn't have done that with what I've got. Anxiously, the barman says, what have you got? And he says, only 25 pence. Let's face a fact. The variation in the valuation of financial instruments is worrying. There are large valuation differences on identical instruments. It's difficult for the regulators, it's difficult for the auditors. There's no benchmark. How can you say to someone, you're too high? There is no standard. And that's why they're so desperately needed. And it's not just for the measurement in the balance sheet or the P&L account. When you look at the disclosures, and Doug quite rightly said, and Mauro too, that we actually have disclosures of fair value so you can compare the loan book, which is at cost. And we had a case in the UK, the Cooperative Bank, December 2012, the fair value of its loan book was shown at 37 million higher than the book value. After well-publicized difficulties and regulatory scrutiny, it said it had reviewed and improved the methods of valuing these loans, and actually they were 3.7 billion less in fair value terms than the figure in the book. That gives you an indication of some of the things that are happening out there. So what are we going to do about it? Well, I was in Ayrshire not so long ago on the west coast of Scotland, and outside a pub there was a sign saying, a pie, a pint, and a kind word. So I went in, the waitress comes along, bangs down a pint, says nothing. She was equally taciturn when she stuck this congealing pie in front of me. And I called after her, what about a kind word? And she says, don't eat the pie. Well, here's a kind word. We're going to have to get together with the ISB and the regulators and say, what's causing these differences? Is it the models? Is it the assumptions? Is it the data? And what should be done about it? And who should do it? Is there enough guidance and they're just not following it, in which case it's the regulator? Are there more disclosures that are required so people are in warning? Or do we have to write standards? And that is a matter of urgency. When I left the ISB, the Financial Times had a statement about what was going to happen. And it said, when Tweedie came to the ISB, international financial reporting stood at the edge of a precipice looking into a chasm. Since he arrived, it's taken a big step forward. Well, there's a chasm out there. When you think about it, if the valuations of financial instruments are seriously wrong and big differences between the financial institutions, how do we trust the income statements? How do you trust the balance sheets? And what does that say for the capital requirements of the Basel Group? And with that happy thought, I'll leave you. Thank you very much.